Jim Rickards, the Fed's lost opportunity to return to normal. Current Fed policy will push the U.S. economy to the brink of recession, possibly by later this year. When that happens, the Fed will have to reverse course and ease monetary policy. Meanwhile, the economic cheerleaders recite recent GDP figures and the stimulative effects of the Trump tax cuts. There's one problem with the happy talk about 3–4% growth. We've seen this movie before. In 2009, almost every economic forecaster and commentator was talking about green shoots. In 2010, then Secretary of the Treasury Tim Geithner forecast the recovery summer. In 2017, the global monetary elites were praising the arrival, at last, of synchronized global growth. None of this wishful thinking panned out. The green shoots turned brown, the recovery summer never came, and the synchronized global growth was over almost as soon as it began. Strong quarters have been followed by much weaker quarters within 6 months on 6 separate occasions in the past 9 years. There's no reason to believe this time will be any different. This expansion has been extraordinarily long, over 30% longer than average, indicating that a recession should be expected sooner rather than later. Into this mix of weak growth comes the Federal Reserve, which is tightening monetary policy, reducing the base money supply and supporting a strong dollar. All of these policies are associated with slower growth ahead and a high probability of recession. In a typical business cycle, the economy starts from a low base, then gradually business starts expanding, hiring picks up, more people spend money, and businesses expand. Eventually, industrial capacity is used up, labor markets tighten, resources are stretched. Prices rise, inflation picks up, and the Fed comes along and says, aha! There's some inflation. We'd better snuff it. So it raises rates, usually for a full cycle. Eventually it has to lower rates when the process goes into reverse. That's the normal business cycle. It's what everyone on Wall Street looks at. And historically, they're right. That process has happened dozens of times since the end of World War II. The problem is, that's not what's happening now. We're in a new reality. This is a result of 9 years of unconventional monetary policy: QE1, QE2, QE3, Operation Twist and ZIRP. This has never happened before. It was a giant science experiment by Ben Bernanke. And that's the key. You have to have models that accord to the new reality, not the old. Wall Street is still going by the old model. The new reality is that the Fed basically missed a whole cycle. They should have raised rates in 2009, 2010 and 2011. Economic growth was not powerful. In fact, it was fairly weak. But it was still the early stage of a growth cycle. If they had raised rates, many would have grumbled, the stock market would have hit a speed bump, but it wouldn't have been the end of the world. We'd just had a crash. But by the end of 2009, the panic was basically over. There was no liquidity crisis. There was plenty of money in the system. There was no shortage of money and interest rates were zero. They could have tried an initial 25-point rise but didn't. This isn't Monday morning quarterbacking, either. I was on CNBC's Squawk Box in August '09. The host turned to me and asked, "Jim, what do you think the Fed should do?" My response was, they should raise rates a little bit, just to say they were going to get back to normal. Of course, that never happened. Now we're at a very delicate point, because the Fed missed the opportunity to raise rates all those years ago. They're trying to play catch up, and its June rate hike was the 7th rate hike since December 2015. Economic research shows that in a recession, they have to cut interest rates 300 basis points or more, Oregon 3%, to lift the economy out of recession. I'm not saying we are in a recession now, although we could be close, much closer than many think. But if a recession arrives in a few months, how is the Fed going to cut rates 3% if they're only around 2%? The answer is, they can't. So the Fed's desperately trying to raise interest rates up to 300 basis points or 3%, before the next recession, so they have room to start cutting again. In other words, they are raising rates so they can cut them. And that's what Wall Street doesn't understand. It's still operating from its old assumptions about the business cycle. Wall Street thinks the Fed's raising rates because official unemployment is low and the economy's strengthening. But as I just explained, that's not the reason at all. The reality's quite different. The Fed is hiking rates because it's desperate to catch up with the fact that Bernanke skipped a whole cycle in 2009, 2010 and 2011. So as usual, Wall Street is reading the signals exactly backwards. The Fed's actually tightening into weakness. So now what? After June's hike, the Fed still has 4 rate hikes to reach 3%. It will likely raise rates at this month's meeting as well, which kicks off in 2 weeks. But at this rate, the mission won't likely be accomplished until June 2019. What would cause the Fed to back off? Any of 3 conditions. Number 1 is a market meltdown. If the stock market sells off 5%, which would be over 1,000 points on the Dow, that would not be enough to throw them off. But if it goes down 15%, that's a different story. Ben Bernanke actually told me that not long ago. Now, if the stock market falls 10% again like it did in February, the Fed will pause. It won't raise. But it won't cut either at that point. Markets are getting complacent again and are not expecting any sudden moves to the downside. But it's when markets are most complacent that sudden drops are most likely. August 2015 and January 2016 are good examples. Another drop could be right around the corner. The second condition is if job creation dries up. Now, job creation does not have to fall dramatically. If you see jobs go below 75,000, the Fed may pause. The third condition is disinflation. Now, I'm not talking about outright deflation. I mean inflation falling substantially short of the Fed's target under a metric called PCE, or the Personal Consumption Expenditure Price Deflator Core. You may be skeptical of how the Fed measures inflation, and rightly so. But you have to look at what the Fed looks at to know what they're up to, right or wrong. And they look at the PCE, year over year. The Fed wants 2% inflation. It hasn't been able to consistently attain it, but it's been getting close. But if that figure drops to, say, 1.4%, that's another reason to hit the pause button. That seems unlikely at this point. Unless any of these 3 conditions materialize, the Fed intends to raise rates 4 times a year, every other meeting, until the middle of 2019. If any one of those 3 things happen along the way, the Fed will probably hit the pause button. If all 3 happen, it will definitely pause. But for now the Fed remains on course, is tightening into weakness, and will have to backtrack once it helps bring about the recession it's trying to avoid. Unfortunately, it'll probably be too late. Regards, Jim Rickards. Don't miss the signs of another slow-motion meltdown if you've ever lived through a life-threatening emergency, whether a car crash, train wreck, or a steep fall. Hopefully not. You have noticed that time seems to slow down. You witness your personal jeopardy in slow motion. A memorable example of this is the film The Matrix, in which the hero, Neo, could dodge bullets since time moved in slow motion for him. According to the best science, time does not actually slow down for those in jeopardy, nor do their perceptions slow down. What happens is that the stress and novelty of the experience causes the brain to create extra layers of memory, a saturation effect, compared with everyday experiences. According to researcher David Eagleman, the more memory you have of an event, the longer you believe it took. So yes, time does seem to slow down in a crisis, but it's a cognitive illusion. That slowing down effect is important to bear in mind as we encounter the 20th anniversary of the Russia LTCM financial crisis of September 1998 and the 10th anniversary of the Lehman AIG financial crisis of September 2008. For investors, those events were the financial equivalent of falling off a tall building or being strapped in during a plane crash. If you lived through them, you'll recall some hours that seemed like days and days that seemed like weeks. Of course, investors recall where they were and what they did during the absolute height of the panic September 28, 1998 and September 15, 2008. Most investors may not be aware that these peak panic moments had actually been playing out for over 15 months in both cases. Investors who closely observed the early signs of trouble had ample time to get out of the way of the panic itself. In fact, most investors were oblivious to the early warnings. That 15-month build-up was a real slow-motion event, not an illusion. The September 1998 Russia LTCM crisis began in June 1997, 15 months earlier, when Thailand devalued its currency and closed its capital account. For several years, Thailand had maintained a fixed exchange rate to the US dollar. Money poured into Thai real estate and resorts to earn high yields with an exchange rate guarantee. When some investors started to pull their money out, a run on the bank emerged. Thailand could not make good on its dollar guarantee and devalued, causing massive losses for US investors. From there the panic spread to Indonesia, Malaysia, South Korea, and other nations. There was literally blood in the streets as some were killed in money riots. Markets calmed down that winter, but the contagion returned in the summer of 1998. In August, Russia defaulted on its bonds, devalued its currency and closed its capital account. That led to a global liquidity crisis, which caused massive losses at hedge fund long-term capital management. The Fed and Wall Street banded together to bail out LTCM, but really to save themselves. Global markets were just hours away from complete collapse when the deal was finally done. The September 2008 Lehman AIG crisis began in June 2007, 15 months earlier. HSBC had just reported weaker than expected earnings due to higher mortgage defaults in the subprime sector. In July 2007, two Bear Stearns hedge funds collapsed due to an inability to roll over their short-term financing of long-term mortgage securities. In August, the panic intensified and the Fed cut the discount rate, the first in a long series of rate cuts to zero. Three major money market funds sponsored by BNP Paribas closed their doors and suspended redemptions. Bank-sponsored off-balance sheet special purpose vehicles could not obtain short-term funding. Again, markets calmed down in the winter as sovereign wealth funds pledged billions of dollars of new money to prop up U.S. banks. But the panic returned in the spring with the failure of Bear Stearns in March 2008, followed by the collapse of Fannie Mae and Freddie Mac in June. The panic turned into a global liquidity crisis and reached an apex with the bankruptcy of Lehman Brothers on September 15, 2008, and the subsequent insolvency of insurance giant AIG. Wall Street was facing a sequential collapse of other banks, beginning with Morgan Stanley when the Fed and Congress stepped in with trillions of dollars of guarantees, swaps, and bailout money. Both of these panics 1998 and 2008 began over a year before they reached the level of an acute global liquidity crisis. Investors has ample time to reduce risky positions, increase cash and gold allocations and move to the sidelines until the crisis abated. At that point there were bargains galore for those with cash. An investor with cash in 2008 could have preserved wealth during the crisis and quadrupled his money since then by buying the Dow Jones Index at 6,550, today it's around 26,000. Relatively few investors did this. Instead they suffered from fear of missing out as markets rose until the panic began. They persisted in the mistaken belief that they could get out in time if markets reversed, not realizing that reversals happen much faster than rallies. They held on to losing positions hoping they would come back, they did after 10 years, and so on. Simple behavioral biases stand in the way of doing the right thing almost every time. Are we in another slow-motion meltdown? Are markets telling us that another global liquidity crisis is on the way in 2019? It's impossible to know, yet the signs are not encouraging. Venezuela is an economic and human rights tragedy. Turkey, Argentina, and Indonesia, all major emerging market economies, are in complete meltdown. India, Malaysia, Brazil, and Mexico are in the midst of currency collapses. South Africa is in recession. China's growth is slowing and its debt is unsustainable. The trade war between the US and China is starting to take its toll and will get worse. Then there are geopolitical hotspots like the South China Sea, North Korea, Syria, Iran, Ukraine, Taiwan, and others that could turn into shooting wars in little or no time. Investors do not have to take an all-or-none approach. They can keep a hand in the stock market while increasing their allocations to cash and gold. Lower yield on those assets will more than pay for itself if a new liquidity crisis emerges and as bargain prices appear. The point is to act now and not wait until reality catches up to the slow-motion perception. Regards, Jim Rickards.